We're going to be talking about monetary policy now, which is a bit more complex than fiscal policy. And as a result, it'll take a few more lectures. I'm going to start first with a question, because I'll be using this term frequently, is financial paper, which, of course, everybody can think of something like, what is money? Well, what is it? That could get confusing. Well, what is capital? Even what is capitalism? So when I refer to financial paper, one way to think about it is, well, we've already talked government bonds as an example, but think of stocks and shares. We talked about the Toronto Stock Exchange. Sometimes the term is used as security, financial security, commercial paper. This all sounds rather sophisticated, so it might be easier to think of something simple that everybody understands. Well, cash. Pictures with the dead presidents on it or the Queen. But then that raises a question, well, what about debit cards or credit cards? In fact, is a credit card money? So I'm going to step back from this and look at an even simpler example. You go to the dry cleaners, for example. So you go to the dry cleaners, you take them dirty clothing, you give it to the guy, and he gives you, or she gives you, a little chit. I don't know, call it a dry cleaner receipt. It's a piece of paper anyway, a little card thing, and you keep it preciously in your pocket. Why? Because you expect to be able to go back to the dry cleaners next Wednesday and pick up your clothing. Another example of something like this would be if you go to I don't know, people go to clubs in the wintertime in Montreal, there's a coat check. So you hand over your coat and they give you a little tab or something to indicate, and you keep that because you expect to be able, this little dry cleaner receipt or chit, I'm going to refer to it as financial paper. You'll notice something, people hold on to it preciously. And then once you've gotten the real thing back, well, you throw it away. At least the person who issued the financial paper throws it away because it doesn't mean anything anymore. Sort of think of it this way, the lottery ticket. Here's another example, except a lottery ticket is a bit more complex. You do throw it away at a certain date, but you don't take it over to the person that issued it unless you were won something. Incidentally, a lottery ticket is known as an option. It's quite different, a little bit different from financial paper. Another point about the financial paper is that you don't just simply hold it preciously, but it's also transferable. That means to say you can give it to somebody else, and that other person can go to the dry cleaners and pick up your clothing. So you don't have to physically be there to get it. In this sense, financial paper is a good way of thinking about it. It's a claim on something real. And another point about it is if you hold on to that financial paper, then it means that somebody else has access or can be using the real thing, whatever it is you expect to get. I think there's the dry cleaner episode. There's an episode of Seinfeld based on this principle, in which Seinfeld takes his coat in to get it cleaned at the dry cleaners, and then he sees the dry cleaner wearing the coat later. Anyway, I posted it up. You can watch it if you want to. So there's maybe two key characteristics of all financial paper. The first is what you expect to get back in the future. If you take your coat to the dry cleaners, you're expecting to go next Wednesday and be able to get your coat. That's the first point. And sometimes this is referred to as return, patience, expected return, expected value, and so on. If you studied quantitative methods, you'll know it as the population mean, or some of the Greek letter mu. There's a second feature of all financial paper, is that, well, there's the chance. What's the chance that you'll actually get this real thing that you're expecting to get? And that's the notion of risk, chance, fate. In statistical terms, it's often measured as the variance, or sigma. That's the Greek letter sigma. So key idea of financial paper is it's a claim on something real, meaning you say you expect to get something in the future. And then, well, that's a risky claim because you're not certain that you'll actually get it. There's a third concept often associated with financial paper, and that's referred to as liquidity, which is the idea of how easy is it to get this real thing that you may want. And you can sort of imagine it this way: is you've taken your coat in to get it cleaned at the dry cleaners, and he says Wednesday, and then suddenly you need it on Monday. Well, what is is it possible for you to go in on Monday and say, hey, I really need it today. Can you give it to me? The guy might say, yeah, sure, it's ready. Or he might say, no, I'm sorry, it's Wednesday. That's liquidity. And in fact, for me, liquidity and risk amount to the same thing. And in fact, in many ways, risk is much more complex than just simply saying, well, the chance of something, because the chance of a lot of different things. So in fact, what we mean by risk is a broad term, including liquidity. Now, how do you get financial paper? Well, I mean, one way to get it is you give your coat to the dry cleaners, or you give your coat at the hat check place, at the coat check at a club. The way I get financial paper, you have to give up something real, in effect. And the way I do it is I give up my time. And I get paid. They send me. If you want, they can imagine they go to the Dawson College, the office, and they hand over a bunch of cash. A long time ago, I had a job where it was actually that's how I got paid. I was paid with cash in an envelope, but you can imagine too that could be paid with a check. Nowadays, of course, you just generally direct deposit at your bank. But the point here that's really interesting is that, well, then I can go and claim something real. And in effect, what it means is I'm not getting back exactly the same thing I gave up. I can get food. It's a bit like, well, the case of the dry cleaners, you take in a dirty coat, and what you get back is a clean coat. But you don't give up, you don't get back exactly the same thing. The question I want to look a little bit more carefully is, well, what happens if I hold on to the financial paper? That means to say I don't claim the real thing immediately. Well, as long as I'm holding on to financial paper, whatever it is, somebody else could be using the real thing, and that's kind of an interesting story. So this involves the notion of what we call interest. It's the idea that if you borrow something from somebody, that means to say you get the real thing, and the other you hand it over a piece of paper to them. You get to drive around town in the convertible. Well, when you return the item, you usually say thank you as a minimum. This is, in a sense, compensation to the owner for the use of something that you didn't own. So it sounds kind of odd to say that, but it's a bit like if you take your coat to the dry cleaners, and then when the dry cleaner gives it back to you, he says, hey, thanks a lot for having your coat. I was able to wear it out on Saturday night. So this thank you is compensation. It's compensation to the owner because the owner didn't have the item for a certain period of time. Sometimes we say that the owner was patient because they did without. Now there's different words for interest. Sometimes it's called the rate of return, the yield, bank rate, discount rate. In mathematical terms, sometimes they use the letter R, sometimes I, sometimes K. It's usually expressed as a percentage of some value for some period of time. As a quick example of this is if you live in an apartment that you don't own. So that means to say you're using somebody else's home, and as a result, you get to live there, but you pay compensation for the use of something that isn't yours, and in that case, we call it rent. It's the same concept as interest. Now, where it's interesting is there's many different types of financial paper, and immediately do they offer compensation if you hold on to them? So for some quick example here, if you hold on to a dry cleaner, I call it stub or chit, you don't get any compensation. When you bring it back, you could have left it there for 6 months, and he could have been wearing the coat for 6 months, and you don't get any compensation. Hold on to money cash, there's no interest. Coat check, no interest. If you have a bank statement, that means you've got deposits in a bank. The bank will typically pay a very small amount of interest. Go down this list quickly. We'll be looking at credit card slips shortly, but say stocks, you own stocks. Well, then, if the company makes a profit, it'll give you dividends. Of course, the stock or share price may go up. Bonds, we've seen that. Typically, you buy them at a lower price, and the face value is higher, so you get extra. Bonds also have something called a coupon. And we can look. I'll stop just quickly. Canadian Tire money. That's a good example of something. If you hold on to it, you don't get any compensation for. You can go to the Canadian Tire store and get anything you want. That's a claim on a real item at Canadian Tire, but if you hold on to it, Canadian Tire, they don't give any interest. Same with the store gift card. There's another example of financial paper. It's a claim on something real. You can go to the store and get something. I want to finish up with this last idea of, as we've seen before, nominal and real, very important distinction, and it's one of the key ideas, in fact. Nominal interest means the interest is paid just in effect, more cash, more financial paper, more money. Whereas real interest is something real. So, for example, I hold on to something, a piece of paper, a claim on something, and the example I give in class is that I lend a laptop to somebody, and I get a piece of paper, the person issues paper, I'm holding on to it, I can't use my laptop anymore, and when you return this item, or the person returns the laptop to me, they could promise me something extra, like a thank you, that's real, or they could promise me several bottles of wine, in which case, that's real. If there's no inflation, prices don't change, doesn't really matter. I can offer you, say, $60, or I'll say give you 3 bottles of wine. So if you got the $60, you go and buy the 3 bottles of wine, same diff. But if there's inflation, then it matters. And so here's the very simple little formula you can use. The nominal interest rate minus the inflation rate gives us the real interest rate. So if, for example, inflation is 2%, as it now in Canada typically is, the nominal interest rate is typically what's shown in banks. So if you see something quoted, it's going to be the nominal interest rate because it's going to be paid in money. So 7 minus 2 gives us a real interest rate of 5%.